talking about budgeting, those kind of things. So, as we all know, as all of you have experienced, at least if you're a business student, there are 3 reasons for holding cash. There are 3 main reasons for holding cash. Number 1, you hold cash for transactionary reasons. Number 2, you hold cash for precautionary reasons. Number 3, you hold cash for speculative reasons. So the reason why I gave you the assignment is I want you to do it because we will discuss. Okay, if I say we will discuss, people might not do it. Yeah, so I want you to go through as many past questions as possible. And you see the structure of how to analyze the pre-seen material. So please do that. It's very, very necessary. Okay, so 3 reasons for holding cash. Number 1, precautionary. Number 2, transactionary. Number 3, speculative. So what is transactionary? So transactionary is like what you need cash for on a day-to-day basis, right? You need cash to pay expenses, to handle your transactions. To handle your transactions, you need cash to be able to do that. You need cash to be able to handle transactions, to pay expenses, settle debts, all those little things. It's very, very important. Very, very important. Then you need cash also as a precautionary measure. As a precautionary measure. And what do we mean by precautionary? If you've listened to a lot of financial advisors, they'll tell you always have an emergency fund. And this emergency fund is supposed to assist you in case of any unforeseen or unexpected event. In situations like that, you are able to handle, such emergency situation. So businesses usually might hold some cash in order to handle such events. That's very important. Very, very important. Very, very important. So that's something you must keep in mind. So that's the second reason why organizations hold cash. Number 3 is they also hold cash for speculative reasons. Speculative reasons. So when we say speculation, you are looking out for opportunities, for investment opportunities as a company, right? You are looking out for investment opportunities. Very, very important. Very, very important. So why will the business look out for investment opportunities? Because they do not want their cash to be lying down idle. They would want their cash to produce a lot more return rather than just sitting in the bank. So a company might hold some cash that can be used if a business opportunity arises. So why are we talking about all of this? You're talking about all of this because when you look at a company's financial statements and you look at their cash position, you should be able to ascertain why do they have a lot of cash sitting there? Is there any reason? I don't know if anyone has seen Apple's financial statement, but if you look at Apple's financial statement, they have tons of money in cash. A lot of money in cash. So you need to ask yourself, why is it for speculative purposes, or do they have some projects that is coming up some projects that are coming up and all that. You know, that's why they are keeping the cash. So you need to understand why, because sometimes there might be a better use for your cash than letting it just sit down. Very, very important. Does someone have a question? Yeah, Seth is saying that he missed last week's class. So he doesn't know about the assignment. The assignment is, I think, is it November 2018?
2019.
November 2019 past question for strategic case study. Just go there and analyze the pre-scene material. Analyze the pre-scene material. It's as simple as that. It's as simple as that. Okay. So here I say some investment opportunities, such as the opportunity to purchase a rival business, might require some elements of cash. Holding a war chest of cash might therefore be a strategic measure taken by a company to take opportunities for developing the business, blah, blah, blah. So these are the three reasons for holding cash. The three primary reasons for holding cash. Very, very key. Very, very important. Now, what is the objective of good cash management? Why do we have to engage in good cash management? Why do we have to engage in good cash management? Okay, you have to engage in good cash management so that you are able to hold sufficient cash to meet liabilities as they fall due. You know, but you must also make sure that you are not holding too much cash or you don't have idle cash. That's very, very important. You know, so you need to know the right amount of cash you need to have so that when liabilities fall due, you're able to pay them. But you shouldn't also hold too much cash such that there might probably be a better use for the cash than just sitting in your bank account. It's very, very important. Very, very important. So that's why we need good cash management. We always want a good amount of cash so that we can, you know, make some of these payments. Any questions on this?
No, please.
Okay. Okay. Now let's move on to aspects of cash management. So in the exam, you might be required to consider any of the following three aspects of cash management. I think the last past question, the best recent one, you know, I think they had, I can't remember, but I had some elements of budgeting, I can't really remember in it. You might be required to consider any of the following three aspects of cash management. So we'll talk about these three aspects. So forecasting cash flow requirements and cash flow. This is done by means of cash budgeting. So how do we forecast cash flow requirements? You can do cash budgeting or what we call cash flow forecasting. In your examination, it is more likely that you'll be required to prepare a cash flow forecast rather than a detailed cash budget. So that's something you need to be aware of. And we'll probably use maybe I'm not sure they'll repeat how's it called, the previous past question, but that past question had an element, I think was budgeting or something like that to it. So maybe we can use that too if we have time. Now let's talk about the importance of cash budgets. What do we need a cash budget for? Does anyone have a clue when we say a cash budget, what do we mean by a cash budget?
Okay, so a cash budget basically details where the company will receive cash from and how it's going to make payment for payables. And if at the end of the period they forecast, let's say, a deficit, if they need to bring in more funds in the form of loan to supplement the deficit.
Sorry, could you repeat what you said? Can you repeat what you said, please? Can you repeat what you said, please? Okay, I don't think.
Okay, so I was saying, please, can you hear me?
Yes, I can hear you now. Hello. We can hear you. Okay, I think the line is breaking. Can anyone step in? Can anyone help? What do we need a cash budget for?
Okay, so when we talk about a cash budget, a normal budget looks at the income and expenditure of organizations, be it estimates or whatnot. However, when you look at cash estimate, you're looking at the actual projection of inflows and outflows, which are in cash terms, so that at the end of the day, you know how much money you are supposed to have. That is how much money you are going, how much cash you receive, or how much cash you give out during a period.
Fantastic. Fantastic. That's a good one. That's a good one. So that was similar to what I was looking for. So you are just looking at, with the cash budget, what is a cash budget? What it does is it's a forecast of your receipts and your payments. It's a forecast of your receipts and your payments. Very, very simple. It's nothing really complicated. So the importance of a cash budget is to forecast how much receipts and payments are expected to be over the planning period. Over the planning period. Very, very key. But why do we need this? We need to know this so that we're able to check if there are any shortages at any time period, right? or if there are any surpluses. If there are any surpluses, cash surpluses, what are we going to be using the money for? What are we going to be using the money for? So that's one thing that's important when it comes to a cash budget. And if there's a forecast shortage of cash, to consider measures in advance with dealing with the problem. So it's about, that's the whole point of budgeting. Your budget helps you to capture problems, and then you are able to solve them. For example, by planning to defer some purchase of non-current assets, or approaching the bank for a larger bank overdraft facility. So you see, these are ways you can use to solve a cash shortage. Sorry. So let me ask this question. If a company, right, like the company we are analyzing, what's their name? CFL, right? I think we didn't finish, but let's say they are struggling. They have a cash shortage. They do their cash flow forecast and they have a cash shortage. What are some of the ways that you think they can manage this?
I think one, they can cut down costs.
Okay. What kind of cost are you talking about?
Basically, the input costs for the product they produce. So you could look at the input costs. They can manage the input costs.
Sorry, when you say input cost, what do you mean?
So input cost, basically the production cost. So let's say you go to market, or you go and buy something to be used for your production. So looking at the raw materials, how best can we manage the cost of the raw materials? And during the production stage, how best can we manage our production cost?
Okay. Okay. Any other thoughts? How best can we manage the cash shortage?
So they can also renegotiate payments with their payables or suppliers. So for instance, if they have like, let's say 180 days period to pay the debt or longer, so that they can put it, there will not be any cash shortage. Renegotiate terms of payment.
Okay. I think that's a very, very good one. Point well noted. Yes, point well noted. So all of you are right. There are several ways to manage cash shortages. Several ways to manage cash shortages. And yes, you can deal with it by looking at your costs structure. Usually companies will look at their cost structure and see what is actually leaking out their cash. For fixed costs, you can't do much about it because you still need to pay. But for variable costs, yes, you can handle that in a certain way. And what I think Caleb said is also true. You can also renegotiate with your suppliers to see how best you can take advantage of any benefits that they could give you, so that you could can help you in managing your cash. But what about cash surpluses? How do you, if a company has cash surpluses, what do you think they would do? How do you think they should handle it? What do you think they should be using it for? If a company has cash surpluses.
Well, they can go in for short-term investments, short-term security investments. Probably they can go in for 91 day T-bills or 108 something. The money does not lie there either.
Okay. Those are some very, very good points. Those are some very, very good points. I would like to use a past question to illustrate this. So that might be done later. But the November 2019 I gave to you, we would most likely discuss that in class, most likely. So it all depends on how you guys work on it. Yeah, so once you work on it, just in case you didn't get my email address, once you work on it, you can send it to my WhatsApp, or you can send it to this email address. So if you guys are able to do, like, if I see that the participation is good, we will definitely discuss it in class. But if it's not too good, yeah. So what are the benefits of having a cash budget? It helps to forecast how much cash receipts and payments are expected to be over the planning period. It also helps to, I think we've already said it. We've already said these things. Yeah. So hooray, this is what a cash budget looks like. This is what a cash budget looks like. First of all, like we said, it's broken down into receipts and payments. Receipts and payments. Everything here is cash. It's like Ghana's healthcare system, cash and carry. Everything here is cash. So you have your cash sales, you have your cash from credit sales. That is credit sales that you engaged in or transacted in previous months. Maybe you are collecting the cash now. So, for example, let me give an example. So let's say you have, as a company, you have a 2-month credit policy, right? So any item that your customers buy from you, they have 2 months to pay it. So you sell something to someone, maybe a shoe for 10,000 Ghana cedis. And the person in January, then the person pays in, let's say, February, So is that cash that you receive from credit sales that you record here? You don't record credit sales here. The cash from credit sales. The cash from credit sales. Very, very important. Then any other cash receipts, you also record them here. Any other cash receipts, you record them here. Then through that, you would get your total cash receipts. Then you can deduct any payments at all. Payments for purchases, payments for rent, payments for wages and salary, dividend payments, anything that where you had to, where cash left your pockets. Anything that made cash leave your pocket, certainly you have to record it. You have to record it. Then you just subtract your payments from your receipts. And you should get your cash balance. If your payments are more than your receipts, it means that you're in a deficit. Sorry. It means that you're in a deficit. And so as a business, you should be thinking about ways to close that deficit. Thinking about ways to close that deficit. Sorry. Okay, now let's talk about cash flow forecasts. Cash flow forecasts are quite similar to cash budgets. Now, in this slide, we'll talk about the differences between. Okay. So cash flow forecasts like cash budgets are used to predict future cash requirements or future cash surpluses. However, unlike cash budgets, they are prepared throughout the financial year. Cash flow forecasts are more fluid. When we're looking at CFL, I can't remember what, but I think they were talking about they had prepared. One of the problems I had with them was that they had prepared a forecast way before, and they were not preparing, forecast has to be fluid. What do I mean by has to be fluid? So periodically, you need to go back to the forecast. I think we talked about it, yes, and see whether any assumptions have changed throughout the year, and make the changes necessary or feed extra inputs into the forecast if need be. Forecast doesn't necessarily have to be static because as you go through the year, things change, and that's one of the things CFL, Customer Focus Limited, didn't do too well because they just waited. Once they had prepared the forecast, it was just there. It was until things began to go haywire that they said, okay, now we have to go and look at the forecast, and prepare like a forecast to see if everything will go well and all that. But usually when you prepare a budget, the forecast has to be fluid such that it has to respect the fact that things change in the environment. And so you tweak the forecasts according to the changes in the environment throughout the year. So, however, unlike cash budgets, they are prepared throughout the financial year. So forecasts are prepared throughout the year. Forecasting is going on. So, for example, when I used to work in telecoms, we had all kinds of forecasts. We had one we call 2+10. So 2 months of actual figures, 10 months forecast. We had 9+15. We had 9+3. A lot of forecasts, so that throughout the year, as things begin to change, you are able to feed that information into the forecast and have a more realistic forecast. So you don't just do a forecast and just sit there. What happened 3 months ago is very different, right? It's very, very different. So for example, in 2020, you might have entered the year as a company. You've done your forecast. You say, oh, my revenue will be good. Everything will be fine. Then COVID hits. When COVID hits, you need to change your forecast and know that, things might not necessarily be the same. I hope it's clear. If it's clear, give me feedback.
Yes, sir.
So what are the objectives of cash flow forecasting? What are the objectives of cash flow forecast? It's to make sure that the entity is still expected to have sufficient cash to meet its commitments. That's the whole idea of, this forecasting thing. And if there are any periods where there's a shortfall, whatever arrangement the entity needs to make, they need to make it. They need to make it. They need to make it. So that's extremely important, extremely important. So we've already talked about the objectives. It's quite similar to when we are talking about the budget. So I wouldn't want to delve into that too much. Okay. Any questions on this slide before we move on?
No, please.
Okay. If there are no questions, then let's move on to the format for a cash flow forecast. So this is how a cash flow forecast looks like. If you haven't seen one before, this is how it looks like. Like I said, we would use a past question to see how best we can, try and understand this whole thing. Okay, so it's just like the cash flow, right? That you've done in, I think, reporting or the corporate reporting, one of them. You should have done it in one of the accounting lectures. But you start with your profits, you adjust for any non-cash items, adjust for working capital. Why do you add back non-cash items?
Because we are just looking at the movement of cash, and non-cash items don't actually bring about the movement of cash.
Okay, so but why do you add them, not subtract?
Because in preparing the financials, we less them, so there's a need to readjust by adding back.
Okay, that's good. So